Good evening. Ira Epstein, and here we are with your Spider ETF stock market wrap-up. And this wrap-up is for Thursday, 5th of October, 2023. Well, there are a lot of events. What if I told you we're back to building the border wall? Yeah, the president's promise on August of 2020 that there'll never be a wall being built under his administration. Well, there's 20 more miles going to be built under his administrations. Same type of promises he makes when he was going to fill the strategic reserve. That wasn't done. I can go on and on. All right, there's just chaos in the administration right now, but it's all of Washington. It is not limited to President Biden. Please don't write me about that because that's not what it is. Everything's amiss. Who's your next speaker? When do they even have a vote on it? They're talking next Tuesday or Wednesday. Okay, let me think that one through. So that means 2 weeks have gone by out of the 45 days to get the budget, to get everything worked out. And who are they going to bring in? My prediction, it'll be a hardliner, worse than Kevin McCarthy. Where are you going to go with the Democrats on that one? And how do you appease everybody? I am at a loss. So that's politics. Now the market. We get the all-important jobs data tomorrow. I think you got to look at that real hard. As you can see, you're not getting big increases in jobless claims, not at all. You're still hanging around the 200,000 number. The JOLTS number was fairly strong. We looked today and we saw the Challenger Gray number. That only fell by 49,000 jobs. They were looking for 75,000 that were going to be laid off. They're not getting that. Where are we? Well, in the action in the market, it's as though the market needs a bit of a breather. Some momentum to upside and downside have been lost, and the markets are now sort of spinning their wheels. What about this monster break that we've seen in energy? Today, Goldman says it is not warranted. Gasoline is substantially overdone. What about heating oil? Same thing to the downside. We'll see. When we take a look at where we're at, this is Walgreens. We had that bounce, but the market seems sort of stuck right here. Certainly not going up or down at this point, almost like the service there, not getting better or worse. When you come up, you got a higher high and lower low, not really doing a heck of a lot one way or the other. As we take a look at moving averages, you did get back over the 18-day average. This is the pause. Yes, the bias is up. So in theory, you should be looking for buy signals because that's what the work says. How do you get one out of this? I don't see it just yet. The fact that you have a lower low, higher high pattern can't give it to me on a daily basis. And if you got one, you've got stiff resistance at 22.92, about 74 cents higher. That makes it not a big play one way or the other. At the same time, you're overbought. Just don't see anything. So then we come to Rivian. Rivian surprised the whole marketplace. So what does it do? We had great news that it had gotten its production really going well, beating estimates just a week ago. Then, in the past 48 hours, they come out and they tell us that each car's costing them, I think, something like $30,000 in losses. I think it was them. It was a crazy number. And that they need more money, so they're issuing convertible bonds. Uh-oh. A convertible bond is a way of saying dilution. That's right in the market's headlamp, right off the bat. Kaboom. So you take a stock from $25 approximately to $18, just like that. I don't think anybody saw that coming. That came out of left field. You have nothing there. The good news is you had gotten up to the Bollinger Band and collapsed from there. So that part of the trade worked out. In UGA, the gasoline fund, I don't have an answer. This break in gasoline, heating oil, and crude has really taken me by surprise. Number one, I'm not saying you can't get breaks. That's what I mean to say. But this is a monster. You came from 77 to 61 in this all of a sudden, and that's just reflecting what has happened. I get what Goldman's saying. It doesn't mean they're right. Just because the price is down doesn't mean anything. Are people really driving that much less? I think we talked about that yesterday. That becomes a big question. Is gasoline out of demand with all these electric cars? We talked about that a little bit. Are prices because people are scared that with an interest this high, they have to cut back on driving? I assume there's a certain amount of that, but there's something else that nobody's mentioned. There is a certain amount of inelasticity in gasoline. Do I think the market's overdone? You betcha. Does that mean you pick a spot to go long? No. But it also means selling short down here, probably not the wisest thing you can do. In the financial services, you're still in a big downtrend. You're embedded. Until the red line closes over 21, rallies like this are probably sells, and there's something even worse that's happening. Notice how the 18-day average just got under the green line, the 100 and the 200. This is a classic, now crossover, a very bearish pattern on the charts for this. So get a good rally. I think the pros will sell into that with everything they've got. In XLI, fully embedded reading. Same thing happening. Look at the 18-day average, just crossed the 200. You're not quite as bearish here. If the 100 gets under it, the whole thing comes apart. But you can see the industrial sector from the summertime, August, when we were up here. I remember standing here talking to you and saying, I don't get why this is moving up. I'm not seeing the industrial numbers. We would see the Richmond Fed, the KC Fed. We'd look at all those numbers. They weren't strong. And I said, yeah, look at this rally. Well, now look at this break. Something else went on and the market realized it. In AI, everything with AI has been coming down, as you know. I don't care if it's NVIDIA, stocks, everything's been getting hit. You're getting downgrades in some of the big companies, AMD, Intel. You got to keep your eyes on what the different analysts are saying there. In RSP, this is the S&P Equal Weight Consumer Discretionary ETF. The consumer's hurt. These interest rates can't be good for them. Now, the counter of all this is how strong is the jobs data tomorrow going to be? They're looking for 170,000 new jobs. They're looking for the unemployment rate with all the math to slip back to 3.7. That'll be interesting to see what it does. In the home builders, if the red line comes up and over 21, that is when I think you'll begin the rally in the market, but I'm not looking for it to go very far. And this bounce, 77.15, maybe even a little lower, probably no more than that on the first go-round. As you know, I mentioned yesterday, I have problems wanting to really push them, and the reason is they're not caught. They don't have to have inventory. They can sit back, and when you have the money, the financing, they can start your home. It's new homes that they're building. In the energy sector, everything I teach says you don't want to be short when you come down on the first challenge of a 200 and 100-day average and a Bollinger Band. That is not me saying, like Goldman, to buy. That is not what I'm saying. What I am saying is you don't want to be short anymore, and that's what I think happened today. Then we get to gold. I can't imagine why anybody wants to be long still. This can still leak further. Along the way, there'll be out of left field sharp reactions. Expected. Nothing goes like that. A $15 break on a $182 stock and doesn't get a bounce somewhere along the line. But it's in serious trouble, and it's still very much in the bear camp. And the same is very true of silver, except it's not embedded yet. This whole break hasn't produced an embedded reading. It's simply oversold. Will it embed? It'll take another day or so to know that. Copper market, trying to develop its embedded reading right now on the Bollinger Band. What are the metals saying? I think the metals are saying, come on to my house, going to give you candy. Remember that old song? That was a fun song. Well, when I look over here, boy, that's an old song, by the way. I like the oldies, though. When you look, and that was well before my time, got it? But you look at this, and anything in that 36 area is going to be a problem for the market, that 18-day average of closes. TLT, nah. I don't know how low is, but it can keep going lower. Now the question is, you do know that on TV, they've stopped talking inversion. The word inversion means the 2 goes over the 10. For the uninitiated, steepening is the new word, and it's where the back end starts going over the front end. And that's normal. You borrow short term, you don't pay as much interest. Oh, you want to pay a longer loan? Well, it's going to cost you more. Got to tie up my money a long time. I need a higher rate. That's what we used to say. Okay, that is what we used to say. But the inversion created everything. We got as high as about 100 basis points, a full basis point, a percentage point, one full percentage point over the 10. And now it's stuck at about 30 basis points, not even a third over it. And that's called the market switching gears now and going into the steepening. So keep your eye on that. UUP. All right, what do we do here? Well, you can see how this market's fighting its battle, but what happened? Today you lost the embedded reading. If you don't get it back tomorrow, and it's obviously the jobs report, it's going to be a lot, then the odds favor. You're going back to the 18-day average for a correction in the market. Tomorrow's super important here, and it's the flip-flop in the euro, which lost the reading there. And the futures lost their bearish embedded reading too. So I can see a knee-jerk reaction in the two, and then the question is, do they resume their trends, or what do we got? I can't answer that just yet. But I can answer this. If you're looking at the stock indices and you want to see a fascinating report, I did one for you. And this report is not based on bar charts or candlestick charts or anything like that. It is based on seasonality and seasonality alone. I look in all the major stock indices at one thing, the 30-year, the 15, and the 5-year pattern to see is there anything in common, and there is. And it is right now. What is it saying? Well, I'm not going to spill the beans. I want you to go look at the report. How do you see it? First, my reports are only up for 3 business days. So I'm going to let you see it through the weekend. It'll be off on Monday. I can tell you that already. You can either call my staff if you're having trouble, or you go to iraepstein.com under the word research. You will see it right there. What else? You can move your cursor to the top here. You will see an icon, give it a click, and that's how you get to the report. I think this is a major, important report. Scale 1 to 10, I think it's a 10. So you might want to take a look at that. I'm Ira. I will see you all tomorrow. You have yourself a great evening. Let's see if the Bears can rack up another loss. I'm Ira.